Good afternoon, this is Michael Douville, again in Scottsdale, Arizona. It is Tuesday, March 10th. A couple things we want to talk about today that are reasonably significant, but first I have to get my disclosures and disclaimers out. I am not a licensed securities broker, nor am I a licensed financial advisor. All these thoughts and comments are my own, so if you have any questions, you're welcome to call me. We'll put a phone number along here, so you're welcome to call me. I get lots of phone calls, so it's always nice to hear from everybody. Hey, listen, a couple things today I want to go over. We have been talking for the last week or 2 weeks about maybe reallocating some assets. The stock market in the last few days has been extremely volatile. Today, I think it dropped over 200 points. Hopefully we get another bounce, in which case, if it starts bouncing up, you might start thinking of taking some profits. I mean, if you've had your money in the market for any kind of length of time, either in the bond market or in the stock market, I mean, you didn't really have to do too terribly much. You should have some pretty enormous profits. And quite honestly, there are several articles today talking about some business difficulties, and quite honestly, raises some questions as to whether or not we're running into a recession. Things certainly seem like they're slowing down a little bit across the nation. This oil patch and problems, and of course the currency, our dollar is getting so terribly strong, it's going to eventually impact sales. Today we got wholesale sales indications today, and quite honestly, the trade sales dropped 3.1%. They were expected to drop 0.5%, and they went down 3.1%. That's pretty significant. It's the third month in a row that you've had these sales drop. Inventories are rising, and at the moment they're higher than they were in 2007, prior to the recession. So, by some indications, we've got some recessionary warnings going on here. Also in the news, Dresser Rand today. They make diesel engines and gas turbines for the oil industry. They announced that they're laying off 8% of their 8,100 worldwide employees, so that's not a good sign as well. And then you consider that Apache Corporation, they're a huge company. They reported a loss in the last 3 months of 2014 of $4.8 billion in 90 days. That is pretty significant. Now, when you start thinking about these oil patch, oil industry companies, you have to consider that not only do they have stocks that are going to go down, but a lot of these guys are hugely indebted. And if they're indebted, they've been borrowing cheap money, an awful lot of junk bonds. I'm hearing up to 20-30% of the junk bonds issued went into oil-related industry companies, and they're in trouble. So you have to consider that if you have junk bonds, those may very well be at risk, and the same with the stock. So we had a pretty good down day today. Hopefully we get a bounce and we go back up to some levels, but you might consider taking some profits. Now, I've talked about taking a third, maybe a third or a half, but you need to talk to your advisor, you need to talk to your significant other, and go over some things as to what you should take. You can always put this money back into the market if we're wrong. It's just that if I'm right and the market really takes a drubbing here, there's an awful lot of red flags on the international geopolitical arena, as well as some economics that, if they drop, it'd be hard to get that back. You can't put something back into the market that you don't have anymore. So listen, what I want to talk about is reallocating the stock funds. You should really consider getting into a cash flow position. Now, if you go into an asset class like the real estate, which is what I'm advocating everyone to do, is to get into some kind of a rental income class of properties. And we have tons of them here in Phoenix, but almost anywhere that you live in the United States, you're going to find an area that's going to work well for you. If you're in the high rent districts, as we've talked before, like San Francisco or the Silicon Valley, San Diego, New York, if you're in Sydney, if you're in Hong Kong, Paris, you're going to have to probably come out of those areas. But there's still plenty of properties around the United States here that you can get some cash flowing residential properties. Now, the reason I'm saying this is, although they're economically sensitive, our real estate business is economically sensitive, and in the 2007, 2008, 2009 debacle, properties dropped 60, 70, 80%, but keep in mind that they were hugely overpriced. So at this point in today's marketplace, Could they be a little overvalued? Well, they might be optimistically priced. Some markets around the country might be a little bit pricey. They're nowhere near what they were in the bubble years of 2005 and 6. So there's a possibility that they could drop a little bit. So you're always at risk. We're economically sensitive, and prices could come down. But what we found during the Great Recession was that although rents were impacted, they weren't impacted anywhere near as much as they were the price, and they were like a lifeboat. So this, when you're looking at an income property, if you're looking at an apartment complex, or you're looking at a residential rental property, we have a lot of single-family homes that are rentals, and the income just keeps coming in because it's a basic commodity. People need a place to live. It's one of the last things they stop paying their rent on. So it's a reasonably conservative way to get cash flow into your account. Now, what if I'm wrong and the economy just explodes and keeps going north and everything is just fine? Well, you own some properties, and properties have continually gone up in very good markets. So if the market gets good and the economy starts getting good, well, then I think that the worst thing that's going to happen is that you're out of the stock market, you're reallocated anyway, and that you're going to get some properties that will appreciate and they'll cash flow. That's what you're looking for, is something that's a cash flow. So what I'm going to advocate for you to do is to look at the real estate for an allocation model. I would say take a third to a half of your portfolio. Let's get it into a different separate asset class. Worst case scenario, if what I think is going to happen happens, we're going to have a little deflation first, where you see credit contract, where you see prices drop, and you get this huge correction in misallocated funds. All these funds that went to pay for gold mines that weren't profitable and oil wells that weren't profitable, those will go bad, and we'll get a level playing field. And then what I think will happen, you'll see inflation. So in both scenarios, real estate does reasonably well. Once we come through this, you can get growth, you can get appreciation, and you might be looking at just one of our average rentals that you're getting $6,000 to $8,000 a year. And if everything goes well, you might be able to get 3% next year. You're going to be able to have 3% the year after, and continually grow that. Worst case scenario, we have a little bit of downside to it, but you're still going to get your cash flow. You'll constantly have money coming in, and that's what I think you're going to be needing very, very quickly, because I don't know, everyone's looking for yield in today's marketplace. We need cash flow. If we have some economic downturn, people are going to be economically impacted, so you might need some passive income. This is one of the best there is. You're welcome to give me a call and discuss any of this. If you have any questions, give me a call. I answer my phone, so tomorrow we'll probably talk, or later this week, as to how to find some good properties. We still have them. They're not as easy as they were to find 4 years ago, but we can certainly still find them, and certain things that are worth owning. So my very best to you.